Barry, we were just talking about kind of how we got here in terms of the higher inflation and how, I don't know, maybe it's a little bit different this time because we haven't seen this type of monetary policy and you're talking about a bit of a lag effect. So, what does that mean then?
Well, I think that because this recession or recovery was induced by a pandemic and we had enormously strong monetary and fiscal responses, we don't really know what the monetary policy lags are. It's obvious that the lags are going to be shorter this time around, but we don't know how much shorter. And I think there's a great deal of a certain uncertainty around that. And there are, the market is anticipating rate cuts because they think that the tightening of monetary policy is going to slow the economy very, very quickly. And I'm not certain that that's the case.
Why are you not certain about that, Barry? If you even just take a look at, and I think this is what people are really focused on, is the employment picture. And you are hearing more and more companies, predominantly in tech, and tech doesn't account for the majority of jobs out there, but you're really starting to see companies make layoffs. And the expectation from what I hear is that more will come. And quite frankly, that CEOs didn't want to do this before the Christmas time period, and now we're going to see more of that. Will that not cause some severe weakness within the labor market and therefore the overall economy soon?
I think it'll create weakness, but I'm questionable as to whether it causes severe weakness enough to make the unemployment rate go up. And I think that the pandemic essentially decreased the labor force participation rate significantly. I think people are still leaving the labor force at much faster rate than we've been used to over the last 15 or 20 years. And the layoffs are offsetting that. And, so you've got an offset between declining labor force, which is naturally happening because of the baby boomers and then exacerbated by the COVID pandemic, against the layoffs. And so far, it's been an exact kind of match. The unemployment rate is still at 3.5%, a record low. And if this continues, the Fed isn't going to be able to get the unemployment rate to 4.5 or 5, and wage growth isn't going to decline. And if that happens, then the Fed isn't going to be able to cut, and the market is completely mispriced if that happens.
So it sounds as though that's the side you're on.
Yeah, like I just don't think anybody has any idea. The models don't work for a pandemic. But the evidence right now is that despite all the layoffs, the unemployment rate isn't going up and jobless claims went down, and it's very close to 200,000, which is almost rock bottom.
Yeah.
And maybe there's some seasonal effects there because of Christmas and the holidays and that. But until we see jobless claims going up to 260 to 280, the unemployment rate is not going to rise. And if the unemployment rate is not going to rise, then the Fed's not going to be cutting.
So do you think then the Fed's got their eye on the wrong ball? I mean, because what you're describing is a dynamic that's not going to change because of demographics, essentially. That's one aspect of it. So if they actually look at other aspects of inflation, which, as you say, the trends are coming down, why won't their focus be that and therefore start to pull back on the tightening? Again, I'm putting out the
Well,
bull case.
yeah, like unemployment is much more political than inflation. Inflation became political over like 4 or 5%, but inflation under 4% isn't political, but unemployment is always political. And this Fed has proven to be, quite political. After all, the Fed chairman is appointed by the president.
Right.
And so I don't think they're looking at the wrong place, but And I think that's why the Fed is saying we're going to have to keep rates higher for longer, because inflation isn't coming down close to their targets and the unemployment rate isn't rising. And as I say, the market is priced for rate cuts, not for a prolonged
Okay.
period of
Okay.
rates at
We'll
5%.
take